Spreadsheets. So 99% of budgets worldwide are basically completed using spreadsheets. And the real reality is they're not designed to do that. So we are looking at how we can provide budgets, cash flows in a far smoother, more effective and efficient way. So what is Forecast5? It is a purpose-built budgeting and forecasting solution. It is set up to allow you and customers to easily and simply prepare budgets and forecasts. And we deliver fully integrated reporting financial statements. So the profit and loss and the balance sheet link, and the cash flow and the funds flow statement link. So it's very easy to change and revise. And we also handle actuals, variances, rolling forecasts, and reforecasting and new projections. So we just drive this thing. So tendency to look at the current situation as a setting point is Excel. There's anything of it, 38% of Excel with unintentional errors to working with formulas, whereas you're not actually looking at the budget, you're too busy trying to make it balance. There is no reports provided. Take on and you'll see something like extend, multi-years, rolling budgets, what if. These are the things that we add to the budgeting process well beyond what most people can even get close to with Excel. As well as the preparation of funds flow reports. I think I've run across one person worldwide who actually managed to do a funds flow in Excel. We manage payment and receipt terms by record type, not a generic 30 days afterwards, but individually. Currencies, tax, PAYE, GST, etc., all individually record-based versus system-wide. The Excels are not purpose-built. The import is manual. You get a lot of this update link sheets. And I mean, the classic I see repeatedly is, I've just come into the job. This is the budget from the previous predecessor. I have no idea what's happening. And I mean, they are seriously, some of them are quite monsters that I've seen. I mean, I've spent, I think, some couple of days at one of them trying to work out what was happening. Right, so Forecast5, it's purpose-built. We're trying to deliver error-free budgets and forecasts so we can prove our numbers balance between the cash flow and the funds flow movement. We introduce a range of record types and methods, and each of the record types and methods enhance the way it's done. So we have a record type for an accrual or prepayment. So we automatically manage the accrual and prepayment balance in the balance sheet, as well as the recognition of revenue or costs. We have a nice one-touch reporting function, which takes all of our reports out to Excel. So we use Excel in the way it's best designed to be. I think about 99% of all of my clientele use Excel for reporting, and that is in the corporate market. And so we're not trying to fight that, we're just trying to do the calculations. The reports are done. So we've not only got these standard basic financial reports, but there's variance analysis, rolling forecasts, what if forecasts, as well as schedules for employees, fixed assets, GST, and a range of other things like that. So what if scenario, having completed the base budget, you might say, what if sales change or what if costs change? Actuals. So the recording of month-by-month actuals. Now, as we're integrated with MYOB Advanced, we're able to import those at a press of a button, and therefore you can then get variance reporting. Now, variance reporting is one part of it, but what actually happens from there is our rolling forecast takes us on board the current actuals and then extends the projections based on what you want to enter or further. And all of our budgets can be extended out to 15 years. We have a range of integrations, but MYOB Advanced, MYOB EXO, and MYOB Account Writer are common. And we also have a lot of work integration with Excel as well. Report views, customized dashboards and reports. We use the reporting views into Excel to bring data like that across. Right. So detail-wise, we do per record settings, and the record types and methods work to give you the calculations that you're looking for. Things like currencies, GST, we handle those automatically. Wages, staff, PAYE, pension, bonuses, we all can do that. We have journal capability, i.e. non-cash flow, memo and assumption records, which allow you to make calculations, KPI-based calculations or revenue builders, and record all the assumptions so it's an entire solution. We can consolidate divisions with conversion from overseas currencies, and you can then consolidate those consolidations. The levels are basically limitless, but in reality you might get up to 4 or 5. So we can handle multiple levels, cost centers and departments, departments into companies, companies into groups and that. And we have an MYOB Advanced integration, import, export setup. So that's the setting of the scene. So we're going to move into the product, because that's really what we want to do, is give you a look at the product. When you log into Forecast5, you'll be presented with a screen which gives them a list of forecasts or consolidations. And consolidations talked about. On the right-hand side, we have a range of new forecasts, new consolidation, copy, amend, change, export and import, and export forecast data. We also support user management, multiple users into user groups. So we're just going to deal with the two that I have open here. So along the bottom, I've got two forecasts, and we'll just give you a structure and a layout of it. So very familiar Windows Office look and feel. We go through our tabs. So we've got reports. We go into reporting. I should have done this beforehand. This is the one time we now do record calculations. So this is when we make sure debtors, creditors, profit, retained earnings, interest, all of those forecast records that we maintain are correct and accurate. So this usually takes 10 to 25 seconds, but it's the only time we operate it. Right. So our standard reporting menu, we'll come back to that a bit later on. We support a rolling 90-day cash flow position. We have some visuals, graphics, and all that. We have our utilities menu, and this is where we do our settings through the endpoint, set up user connection to the MYOB Advanced. Just backgrounding on that, we can handle segments and we can use sub-accounts within segments. So we handle both of those, and then the data is imported and able to be mapped and built in there. And then the help menu. So this has such things as email support, that sort of stuff. We'll get out of there. Knowledge base access, about, licensing details, right. So back on the main menu, along here we have our forecasting records. So in this we can open and close, save as, new forecast, export the forecast from here. Along this screen we have our data records, so adding folders, adding records, show system data, delete records, move up and down. In the department folder, we have the options for handling departments, so they are a particular functionality to do trading accounts. You can handle that. We have our consolidation screen, so in the consolidations we can handle eliminations, goodwill, intercompany transactions, subsidiary and minority interest, as well as associate interests, all handled correctly for the fact there. Our settings menu, and we'll dwell a couple little minutes in here in a second. Opening balances, so we bring in the opening balance sheet with an integration. It's an import function, so we can actually do that, or you can modify or enter it manually. Once you've done that, you need to set your trade debtors and trade creditors balances for receipts and payments. The actuals process starts with turning on actuals, and on the far right we have our what if analysis, so we'll get into just seeing how they function. At this point, I've clicked on the sales section, and all the blue items are section headings, and you can have as many sections. You'll see here that it's a sales type. We then go to our cost of sales as cost typed, and then down into overheads further down. If we scroll down further down this record tree, we've got a few records. We then hit other income, and then we move into the balance sheet, fixed or the bank, fixed assets, loans, all the other assets and liabilities, and down into capital. And then the last three, or two of the last three, is memo records. So this is KPIs, the assumptions, and then the forecast is at the records at the bottom, which is where we calculate and point out, bring in those figures that we manage: capital, retained earnings, income tax. Right. So there's a range of right-click options. We can collapse and expand. We can right-click on there, and we can add a record or a folder through all of that, or use the menu options. In the middle here, you'll see that the sales section is displayed. Each section has a what-if multiplier, so we can do a generic what if all of our sales go up. And underneath is displayed the records that are contained within the section and their values. And there's some options to look at these in sum or aggregate or whatever you wish to do, and see those figures there. Clicking into a record, if at any point we want to add a record, we can go simply right-click, add record. We can move records between sections, or we can delete them from here. Now, the sales name, 99% of everything Forecast5 does is based off the name, right? So this is where we consolidate by name at the moment. We will be consolidating by general ledger code next week. We'll be finishing that development. The description field is imported because this is actually imported from our demo data set. Record types, which we'll deal with in a little bit more. The bank account, our currency, our tax rate are all set based on our settings. So we'll go into that shortly. The general ledger code has been imported out of MYOB Advanced. Project code and external code are additional analysis fields. We have a report for that analysis if you want to do that, or they can hold the branch code or similar. Not only does the sales section or sections for P&L records have a what-if multiplier, each record can have its own what-if multiplier. And on the right-hand side here, we have our cash flow or our daily cash flow calculator. So this record is going to be receipted 20 days after the month end in 4 equal weekly payments. And I can see that simply by going into show system data. And that will display the daily cash flow receipts, and you'll see here it's been split out by each of those figures. Do that. And that's then added into the daily cash flow report as a template to allow you to reschedule. The options in there include fortnightly, bi-monthly. Okay. So let's firstly look at record types. So the 3 record types we support is income, separately invoiced, and accrued and prepaid. So an income is normally credit sales, GST, and debit debtors. Separately invoiced income allows us to do a range of additional things, and these are things such as separately banking things or paying things out of different bank accounts. These allow the separately invoiced income records can be eliminated on consolidation. They're excluded from factoring, i.e. we support financing of stock and debtors. So if you do not want a records financed, they will show separately on the cash flow, and they will show separately in the balance sheet. So they'll follow the whole process through. Currencies are allocated per record, and the definition of currencies is done in our details. So we can provide demo, we provide standard the 3, but it's very easy to add any new currency you wish. Just give it a name, give it a symbol, and give it a acronym like that, and define an exchange rate, 66 or something like that. That currency is then applied to this figure. Any budget is done in yen, etc. GST, exactly the same. So let's just tour through the settings to understand what flexibility. The scheme, the period, quarterly, monthly, what month it finishes on, month in arrears is specifically for the UK. The VAT is due 7 days after the month after. So we've handled that, and that gives us a capability of handling other things. GST, exactly the same as currency, can be added, defined, changed. We've catered for a change of GST mid-year, like we all experienced several years ago. Handle that. Profiles, these are seasonal or spread codes. So we can have an even spread as our default, 4 weeks, 4 weeks, 5, those combination of weekly scenarios, a fortnightly scenario, and I'll show you this in use a bit later, where we have 2 fortnights most months, but in November and in April there are 3, and this is used for something like, this one specifically we'll use for fortnightly payroll. Seasonal is just simply a bunch of numbers totaling 57, and we will use that a little bit on these records. Our payroll tables, customizable, definable, pension details, KiwiSaver, Australian Super, and they're done there, and it's very easy to add a new scheme, so something like Kiwi 4%, and you get the option for the employer, they're paying 4, no, the employer is paying 3, and the employee is paying 4. And we will automatically apply that under the employee groups records. PAYE options, monthly, twice monthly. We've handled contract retentions, forecast other options. That's just how our cash flow manages, but the preference is the interesting one. This is where we've introduced a few little tweaks for clients, splitting long-term and short-term loans or all long-term. If you're running costing, initially we started with wine costing. So when it's sold, was the standard cost of the wine going to be based at the end of the month after production, or before the production at the beginning of the month? So we set that option. A really interesting one is the daily cash flow. So what happens to the weekly payment days? Is it done on Friday or is it done on Monday? So when that fourth day of the month falls on a Saturday, we'll move it back into Friday, or should we move it to there? Some other things like that we've introduced throughout the system. And then parameter defaults. When we create a record, it will start like this. So that's all pretty straightforward, once set. Now, none of those settings are permanent. Every record is adjustable. Okay, so we've got the details of there, codes, all of that. So next thing we support is the methodology for calculating the budget. So at the moment we have manually entered. So these figures have been can be manually entered from anything from set all at the top to set all and apply the standard profile automatically to those records. The range of these afterwards, they range from options like profile, which we saw up here, grab our seasonal profile, put in 5 million or 57 million, doesn't matter, and it will apply that profile to those figures and make that calculation very simple. Calculate from units, we'll see that a little bit later. Percentage of sales, cost, wages, they're all metric, or what we call metric-based budgets, where you're doing percentage of allocations. Percentage of memos is a little bit different. So if I look into mushroom sales here, which I've done there, it's done as a percentage of memo and sales by product. So the memo records, as I said, are calculated down at the bottom here in this. Now, there are a range of processes, things that we can do within memo records that are very effective. These records start off being non-financial, but as you've seen, this has been then brought into the model. So if we wanted to do something like number of rooms, so we've got, just keep it simple, 50 rooms. We'll print that on the gross profit. We'll add another record and number of days in a month. However, we also have a range of predefined answers for a lot of this stuff. So days per period, sales units, cost units, number of employees, depreciation, percentage of profit, percentage of loan. All of the current data structure set is pretty much available. And we'll just go back and get that number of days. It's very, very capable of there. So it's calendar days, because we rent that. And let's do the average daily rate. And we'll make that $150. So we'll put that in there, and in June we'll make it $180. Now those are 3 records there, and I can do one of 2 things. I can, at this point, calculate accommodation revenue. And that's where we use a formula, and formula and memos are really nicely interlinked. So I can go into a formula. You will see here, I can access just about every single record in the budget on the profit and loss records. And then I can come down and I can go number of rooms times number of days times the average daily rate. We've got to add the times, add, and then we go times the average daily rate. Right. Now, I could have done a occupancy percentage and a few other things, but you get the general gist of the flexibility here. And we've decided that that's called the accommodation. I'm calculating that down there. I'll go to my record here. We'll call that room revenue. And we very easily either go percentage of memo and select the accommodation, give it 95% if we wanted to do whatever, or I could equally have used formula yet again. And so with the formula, I would just scoot down to accommodation, and that's in. Now the key with that, so we're flat $375,000 until our day rate goes up, but we want to model very quickly, number of rooms, we're going to change it to 75. Right. And simple as that, we now have that change in the last 2 months. So KPI-based budgeting, very simple. Right, so what's the reality happens with businesses out there? The General ledger is representing the chart of accounts, which we are all familiar with, and that produces financial numbers. However, the truth of the matter is most of them will budget by either their customer or product structure. So how do we replicate that if we're integrated with MYOB? Well, one of the ways we did this is we set up a second forecast, in which we use mushrooms as a formula, linking to memos for the volume and the rate, that sort of thing, and we calculated that revenue. We have a capability in here where we can get total turnover of mushrooms as a memo record, and one of the options under our memo records is to hot link to another forecast. So we have gone down here into our mushroom sales, and we've got a memo record sales by product. Sales by product sits down here, and it is hot linked to the memo into that other by product forecast. The other part of this is hot links can also be applied into Excel to bring in data. But what this allows us to do is that the initial P&L might show mushroom sales domestic as a value, and that's what we've got in advanced or anything like that. So what we want to do is rebudget it going forward based on memos. So we can take the combination of both and do that. So that's the sort of stuff that we get into with building budgets. We can also do things like discount given, can be negative 2.5% to provide a given discount based on a percentage of sales. So these record options continue down beyond formula into sales units, so co-product, by-product sales. Stock on hand is a unique record, which allows us to do work in progress from employees, so if you're uplifting staff, and then, as I said, hot links. So those are the revenue style of records that we support. Cost records or cost sections, there's some additional cost types, and we do certain things. I'll just find a record that's not linked. So we have a normal cost. We have an accrued and prepaid cost, and I'll show you that with our insurance prepayment. Stock made and stock on hand. There are 3 types of stock records, and they support 3 types. First one is really just a simple stock and a number of days on hand. The second one is manufacturing, and the third one is work in progress. So stock on hand was designed where we take grapes, we grow them, they grow in value, we harvest them, and then we put them into the vats and they grow in value again until we can bottle them, and we add the bottling costs, or we have contract growers and all of that. And I have a demo model set up around that. In addition, we have wages and gross wages records, and then the separately invoiced cost stock representing that. So let's have a look of how a cost of goods made record could work. Right. So cost of goods made, stock made, has been set up as a percentage of sales. So that is the option to drive this cost. Percentage of sales, sales units to, from, or hot link, normal stuff there. So we've picked mushroom sales, 10%. Right, so along here, we have the components. So those of you who are comfortable, bill of materials. So we're going to add some labor. Now the labor we've just said is $20,000 a month, but what we've been able to do is select the labor record that we're transferring it. So this is your manufacturing absorption of labor, right, in play. Now, fundamentally, think about it, we're budgeting, we're going forward, it's fundamentally a standard cost inversion. And that cost of goods sold, so the raw materials. Now this is a little different. This has been set up as a draw from stock record versus draw from wages. And this is going to place the demand for this component or multiple components on the cost of goods sold raw material, which is set up here. So that total 590,000 is sitting there. And then the final type is transfer from net costs. So this is where we might absorb our power or lighting or overheads that we want to absorb as standard there. You can link this to variance analysis and things like that, or absorption. So you won't have variance analysis, but in actuals you will. So those 3 components form together to give us a total cost of the components against our cost of goods sold. Okay, we're not actually producing enough to get ourselves back into profit, or sorry, to exceed that cost, but we can manage that by increasing these figures a bit, and then we get some stock on hand, that sort of stuff. So let's just look at the goods raw material. So this is an ordinary stock record with a to from, and you can see this $589,000 of demand. So now, as a component, it's got its own purchase supply. there's a 20-day payment cycle. Sorry, no. We want to hold a number of days on hand. So this is our stock, how we're adding it to stock, and therefore this is our purchases. So we have no stock on hand. We'll make it easy. We'll make it 30 days. Immediately, I need to get 30 days, the next month's stock on hand, 150. To do that, I need to buy 305,000. Right. That then leaves me with my balance sheet stock. So we have handled the sale, the cost of sale, the purchases, and the balance sheet in one record. You can imagine the flexibility and power that gives you. I haven't yet covered too much about payment method and receipting method. So you may standard just default everything to 20 days credit, and depending on the setting after the day or even during the month. But we have other options, payment profile. So we may pay 50% 60 days in advance and 50% on arrival or afterwards, those sort of things. So that's a payment profile, and we've got manually entered. If I take you just back to one of these records, income other, separately invoiced, you'll see here we handle monthly, 2 monthly, quarterly, 4 monthly, 6 monthly, annually as well. So those are different payment methods that are available. So that was looking at the cost of goods sold record, 50%, our payment cycle, and our receipt cycle. Moving into labor. So just rooting through here. There are two types of wages record, gross less PAYE to net, or net plus PAYE to gross. So just the way it calculates. However, there are 5 methods of doing wages. Manually entered, profile, so we can use a profile for salaries. Our salaries are this. Percentage of sales, I'll come back to employee groups or hot link. So employee groups is the most common because it allows quite a range of flexibility. I can enter my warehouse staff. I can say there's a number of them. I can put them on an hourly rate, $22.50. From to the end, I can put them on KiwiSaver 3%, and I can default that. What this record right now is doing is calculating the PAYE for me. It is organizing the fact that the pay has been split between the net wages and PAYE and applying the PAYE rules. I can then go into bonuses. We can actually either have a uplift, 110, or a downlift to 80%, and that will factor those wages for that record by that. We also can calculate commission, either manually entered, call it a bonus. We can pay out a $105 bonus, and that will add that to the payroll. Or we can use formula to calculate something as a percentage of profit share, whichever one suits for the way we want to do that. So that's our warehouse staff. Let's add a few more. Let's have the manager, or the manga, depending on here, we all know what that's like. Put them on a salary, or her, 60,000. We could have new staff, and they're going to start in January. On KiwiSaver, we're going to have 2 of them start, and we'll start them on $18.50 an hour, something like that, whatever the minimum is, 20 is it nowadays? And you can see here the payroll kicks in there. So you can build this as many ways as you want, and you can create as many records as you want to reflect it. Now, I mentioned fortnightly. So right at the moment, we've got a flat rate for the first 6 months, fortnightly. Let's apply a fact that we're paying it fortnightly, and November was our 3 fortnights. 60, 60, 60, 90. So our gross is there. You see our PAYE jumps to reflect the reality. So our PAYE payment in December will be 23,000 plus whatever else goes for that, like whatever other wages records are there. So very straight, capable, flexible scenario, both handling macro for volumes and detailed if we wanted to get into individual budgets for wages. Let me pick on our insurance record. Let's show it, it's an accrued and prepaid. Let's change it to a prepayment. So it's a prepayment, and we're going to prepay it annually, up front, and we'll leave it at July, or we can say which month, or even if we move to August. What's happening here? There's our profit and loss recognition. There's our invoice turning up. There's our balance sheet accrual. So we've got -5, we prepay it, the 5 plus 5 going out this month, and there's our prepayment sitting in the balance sheet, reducing automatically, and then here's our cash flow. So we might pay it in 0 days, so it gets paid in that month, automatically adding the GST to it, or no GST if that's the case. And straight away, everything is calculated based on that. Right. So we can work down a range of these different records and that, but we get down into depreciation. So the depreciation section is a system generated section, and I'll show you how that comes into play next. We can go to other income, and we just have a range of record choices, accrued and prepaid investment income, to recognize that. Now, moving into bank accounts. So as you can see, there's no limit to the bank accounts or styles, but there is one main bank account which we default everything through. You've got your credit interest rate, you've got your overdraft interest rate, we've got our calculated figure, and we're doing very, very well. So we might just go into our savings account, and let's just drag 45 million out of there. Right. Now that flicks back. We now drive that into overdraft. We get interest calculations automatically. So these are the projections. So there's one last tweak around here. In a clarity, we made a realization that to be able to manage journals while non-cash transactions, effectively was just a payment method. So at this stage, you can set up bank accounts as journals, and therefore they will not impact on cash flow. There's a particular setting we've done. So this is how you can journal capitalization of wages to software. You can do things like intercompany transfers through this sort of process. You can do work in progress capitalization, that sort of stuff, all just using that because we can move balances from one account to another. Exactly how you do a general ledger journal. It's just in a budgeting model, we sort of do that. Okay, moving into assets, let's pick on plant. It's a little easier. So, fixed assets, there are now 5 asset types. Fixed, financed, which invokes a loan record against it or a lease arrangement. Either way, it's all handled correctly. We have a new date, start date, we have a term, that sort of thing, and a balance. And therefore, with an interest rate, we will calculate a repayment. So we're doing the calculations automatically, and we've got our depreciation. So just going back to an ordinary fixed asset, it has acquisitions, so CapEx spend, payment for that acquisition, disposals, asset sales, gain or loss on a sale. So if we add $100,000 here, we'll invoke just a 5% depreciation rate. We'll sell $20,000 worth here, but we'll make a gain of $10,000. So the subtlety around that is there's only $10,000 removed from the net book value of the asset, and the depreciation recalculates and recognizes that. So it's that. Moving on to the financed record again, the options. You'll see here I mentioned the depreciation destination. All fixed assets can put the default to that depreciation, but you can place it in any section you want in the costs. So it's just simply a pointer. Our opening balance sheet, which we mentioned up here, they're brought in from the enter opening balance sheet functions. That. And down here we have all our options, compound, simple interest only. So this wage loan record basis is the same as all our other loan record calculations. Monthly, quarterly, 4 monthly, 6 monthly, annually. So the 1/3 deposit, which is why I had this put in, we pay a deposit of up front, we finance it for 24 months, 0 interest rate, 2 payments. Simple as that. Works really well. Arrears, period start date, term, asset cost, interest rate. Calculation of that. If I put a deposit down, 150,000, you'll see straight away our recalculations change. We could have a bullet payment, and this is when they might claim the GST back. So we get our $75,000 of GST back, but it's going to be 3 months after the purchase date. So that then changes that payment because it's going to take off that loan 3 months after it starts. Right? Balloon payment, the end of the finance, we're going to leave $50,000 as a residual. Again, all of our repayments in there, and we've got our disposal, and we can have a holiday. So all of the methodologies that you want around handling a financed asset and the features that go with it are handled. If we picked on the other 2 types, that's standard, that's a loan made. So this is lending, a loan, either as calculated using the same routines or a manually loan made. So this is finance companies, factoring companies, those sort of things, or business investment. The last record type is another fixed asset, and that handles investments in shares. So if you have a subsidiary and you have an investment where you've got goodwill, when you have a consolidation of that other fixed asset and that net value of that investment, that creates the goodwill, and we handle all of that on consolidations. Right, so moving down into the next section, loans. Now you've already seen the loan type of record. So under loans, there's 3 types of records. The only key difference in here, calculated manual, so manual loan, the same representation as under assets. Capital received, interest, calculation. And then the final type of loan is financing or factoring in common terminology. More common and prevalent in the UK, but you can factor your stock, factoring your debtors, right? The rules around that. Next stage of the build of the budget is everything else. So on one side, Forecast5 has now collected all of the capital record, all of its forecast record, debtors, creditors, retained earnings, GST, all of those figures have been calculated. We've just put in our bank account, we've put in our loans and our assets, and we get left with a section to cover everything else. And there's a range of record types to do that, and record methods. So we handle anything pretty much there. And then finally, we move down into capital. So this is where we handle reserves and capital changes. The share capital itself is created in the opening balance sheet, but if it's increased or decreased, you can use the capital changes record. So we handle all of those, right? Okay. So we've got all the way through that. What I'm going to do is I'm going to put in a couple of little bits. We've got an income tax provision, and we're going to make sure we pay our dues a couple of times a year. So we'll put that out there, and we'll pay that out there. And we'll pay that lot there. The key of that is because we've got to recognise we actually have to pay it. So in the same time, our shareholders want to see that there's a dividend, so we've got a 50% calculation after tax. Right. So everything else we can leave, well, we can run with, we can put in bad debts or similar, but we don't need to. So this is now going to run the system record recalculation, because now we're just going to look at our outcome and results. Right. So if you've got any questions, feel free to put them into the question and answer box, and we'll address them afterwards, or if it's something I'm calculating through, then we can try and address it there. So happy to interface with whatever you can. I think over the my time, we've managed to get most of that. So our reporting menu, let's just do a show all, because that's probably the quickest version. We have profit and loss by department. Oh, sorry, I haven't done the opening balance sheet. So let's do a quick tour of that. That's all I'm going to do, is we'll go to opening balance sheet. That brings up a screen for entry. You can see here that import button. It will use the start date of the forecast, which we created at the point, to get the months before balance sheet and import it. And so we bring in our assets, we bring in the depreciation, we bring in our debtors, creditors, and all of those records there. There's a few setups around it, because like loan records have to be set with their term to be valid and set as existing liabilities. And technically we should balance. We've got a lazy man's job out of this one, which is called an auto balance. So for life today, I'll just let that run, and I'll come back and look at these reports. So let's go look at the report, profit and loss report first. Okay, revenue. Going down into costs. There's our memos printing out, so total revenue, number of rooms, that sort of stuff. Down and through to our direct costs. So our advertising is running in negative, which I think I set up as a percentage of revenue, something like that. Down through salary and wages, our depreciation on all the records, finance costs, trading, GL income, our tax, our dividend, our net profit. Okay, no worries. Cash flow. Right, so anything that was a standard income record has gone to trade debtors. Separately invoiced and accrued and prepaid show separately on this report. So we can see here our sales revenue coming in. We can see our loan revenue, which is interesting. I'll have to find out why we're banking so much on that. We can trade creditors' payments out. So we didn't open with enough creditors for the payments we made. And we can see our income tax provision, our dividend, our GST, our finances and all that. And we have our opening closing cash position. Now that report was the group report. If I come back here and run the main bank account cash flow, I get just that bank account, which has driven itself out of there. You can see the transfers, do that. So each and every report, every bank account can be reported, or the group can be reported. Balance sheet. So all of the balance sheet records I brought forward and available in that. Each of these reports can be exported to clipboard and pasted, printed, the usual stuff. What I said earlier in the presentation is we have a function called one-touch reporting that will run the reports out into a one-touch template if you use a template. So we can scroll down here. Sorry, we'll just do it a little bit more slowly. So we can see our fixed assets, our total fixed assets. We can see the depreciation that goes with it, our current assets, creditors due within 1 year, net current assets, long-term creditors, capital, and you'll see here it balances. So that gives me the first function that we all know. Balance sheet plus the profit and loss, retained earnings, gives us the end result there. So let's then look at the funds flow report. Cash flow report was there, and then the funds flow report. Now the funds flow report, not many people are familiar with it. I don't know. But it is the movement or source and applications of the balance sheet. So firstly, the profit and loss came in for 99 million. We took out the non-cash transactions, depreciation, whatever. We managed our working capital changes to giving us a total working capital change, cash flow from operations, investing activities. We bought some buildings, we financed some functions, we paid out some provisions and discs there. And our net cash inflow was, what, 81 million. So that is the bank account impact. So if we go back to our cash flow, net cash flow, 81 million. Now I have reliability. I not only can prove that the P&L goes into the balance sheet to give us accuracy on that, but I can prove the spend has been applied correctly. So if I bought an asset, the asset changed and the bank went down, and that is the impact. So that is very important to be able to then take that model and rely on it for decision making. So at this point of time, we've got a whole range of this stuff. I could just hop out to one-touch reporting. I've already got a template linked. I won't print everything. We won't do all of that, but I'll just give you a flavor of running the P&L and we go okay. All right. What this program routine does is it takes all of the reports and exports them out to Excel. Now, it will pop up over here. That template I had set up a cover, contents, disclaimer, company profile, and there's my P&L report for 19 and 20, 2021. And what it's done is labeled it MYOB Forecast 5, and it means I've either got a management pack because I can customize it. So if I go to print preview, select the entire workbook, I've got a 10-page report I can print to PDF or hand over. So you'll see we've underlined, we've dollar signed everything, and we've made it all scale. So it's just an easier way out of it, or we use the reporting views to go from there. Okay. Next thing we might want to do is we might want to make it a 2-year forecast. I'll take that back. So up in our settings, extend and amend, make it a 2-year forecast, up to 15 years, using last year or last 6 months or last quarter, uplift everything 10%, cost 5%, overheads 3%, 3%, and our wages 4%. What that's going to do is just exactly that. It's going to take all of the values and create a second year. So we've got our 2020-21 tab here. And obviously it's a few records in there. It'll take a little bit of time to build that second year. All right, so while that's going to calculate for the next 30 seconds or so. Any questions you can think of, happy to address them. Or we'll come back to them at the end. Either way.
Hey Jeff, that's just a brilliant presentation of Forecast5's capabilities. I think that's the first time I've been through a financial reporting webinar and still been awake at the end of it. So well done. I've got a couple of questions from my side, and while I'm waiting for my questions, there was a question that's been answered already in the chat. So if there's any further questions, feel free to ping them. But just on the webinar, one thing I've noticed, Jeff, is it seems a very intuitive system. How quickly are your customers getting to master Forecast5 on average?
Usually, the package would be 2 to 3 days of consulting in detail for mid-range, what I call mid-range organisations, heading up from 15 to 50 million turnover. Some of them are simpler. I mean, for example, to be blunt, Rainbow Zen was very easy because there was a number of attendees, costs, and goodbye. But an equal business that's a bit smaller was a hell of a lot more complex because they introduced a manufacturing process. So it's a little bit in that. And then another one I've got going, it's got 58 operating or divisional centres, and I just found out today that's not the cost centres within them, but that's a slow burn project because it's a huge operation. But generally work on 3 to 4 days is our normal guesstimate. We can do such things if they're advanced. Obviously, we can import the data, it gets it really quick. Okay.
Perfect. When I see the Forecast5 solution, I look at it and feel that it's a solution that's sorry, I've just got a phone. A solution that's suitable to all verticals. Firstly, is that a correct assumption? And if so, you know, what are the verticals that you're having current success with at the moment?
Okay, the budgeting is predominantly a horizontal, to be interesting, but we have basically commercial, not-for-profit, and then the chartered accounting markets. There are 3 segments. So chartered accountants, they prepare budgets on behalf of their clients and tend to be budget, bank, and put it in the drawer. But the commercials, where we're all playing with the medium to larger companies, we're looking at those that manufacturing, distribution, as I said, not for profits because their focus is on the cost management. Their revenues are a bit easier. The businesses, they know their costs very much better, but their revenues are a bit harder to determine. All right. So, but we've done. Oh, look. I mean, I'll give you an example of what we sort of think. How this little tab. Where have I gone? Preferences. This little feature here. Move fixed assets gain and loss to the depreciation destination. So one of the EPL football clubs in the English League or the UK League, your player is a cost centre. It's a department, and you depreciate that player. And if you sell them for a gain or you sell them for a loss, you show that gain or loss in that department. I mean, it's a soccer club, and they use Forecast5 to do their budgets. We've got a range of things. I'll give, you know, industry-wide trucking companies, trucking retailing companies, shipping companies, a whole range of those industries there. So, okay, this took a little bit longer, but we've now got a multi-year forecast. And if we look at the figures that we've put in place, not those ones that won't work, we'll come down to these ones. We can see that they're all KPI driven. So this, yeah. I didn't give myself a single 4.5 plus 10%, 4950. Now, what that then gives us, as I showed there, is we now have multi-year forecasts. You can do them like that. The next other feature, or another feature you might do at the same time, is you might also want, and I will do this, is just trim it back to 1 year. Right. Is what if? So what if our sales, and just focus on that 1,100,000 as our primary. What if our sales go up 20% on that? And then we go into the record itself and we say, what if it goes up another 20%? So we get a total factor of 144. I can see the what if figure here. And it's lost the number. So where's that gone? Okay. Oh, and then, I'm not focused on that. So we need to do the recalculation down here, but you can see the trade debtors figures. Now, all of our reports are available within that what-if model. So once this recalculation finishes, we would be able to run a what-if P&L, cash flow, balance sheet, funds flow. And we can do them side by side to the budget figures as well. So that's features around what we're doing here and their impact. So you can then get a scenario planning, modeling. You then have a couple of options across from that. You can save it as a new forecast. So you have got this in the model. You can save that numbers as the budget, or as usually what I'm doing for these is just reset to original. So, and I need to untick that to make that work. So we'll just get rid of that. Okay. So just get that through. While it's running its calculation through all of that. Take a little bit of time. What I might do is I can bring off another version. And we can, oh, this is just in a demo model. So just coming down here, you asked a bit about the verticals. Long side, quiet on me. Okay. Right, so while I wait for that all to come back to me, a couple of questions. Defining a hot link in MYOB, the link I showed at the start, that linkage is created from the endpoint. So we don't actually need to define a hot link. It's created as part of a linked budget to MYOB already. So let me get this out of the way a bit. Got too many things going, I think. Right. So too many things going. I think I need to get rid of one of these. Okay. Sorry, Bill.
Yeah, I was going to say, there's a couple of questions in. I've just got one more before we jump into those questions. We talk about this a lot offline. The question is when to introduce Forecast5 into a potential customer. Some of the feelings that I hear is it's the perfect solution once customer goes live. But I like your suggestion of it's very important to get your budgeting right beforehand before you start putting your actuals in the system. So just like to get your thoughts again regarding when would be a best point to introduce Forecast5.
Well, as you and I were talking about it, and I made the comment, you sort of came back to it as afterwards. And I said, well, isn't the first thing to do is get them to be able to show they can afford to it and budget it? So I actually think that probably because it's standalone to start with, buying it up front is just as logical because they can get their budget together. And now that I've got this free, to justify what they're trying to do. And then you also add to that as several business cases that's going to help them increase sales, and you can show them what if our sales do go up or what happens in here. And that's the sort of thing you're looking to do, is to establish your case. So by showing that, and I'll be very clear, there is in this level, no products have this type of solution. There are a couple around which most of us know about, but in doing this level, we're the only ones. The products that have this type of functionality, SAP have a version, Oracle have a version, and Microsoft have a version, and they all start at $120,000 a piece to get started, i.e. more than the ERP, which is why they sell them, that sort of thing. So just going back to the first question, Hotlink, this sales record here has already been linked to MYOB. This is how I created this forecast through there. So the next question led to us, if I turn this on to actuals, which is the next stage, thanks Carl, enter actuals, and I'll just reset these figures, and as usual, and we'll just import July 20 from advanced. So that's going to take that through. We won't get anything with mushroom revenue or room revenue because I created those. But once it finds it, so that's just the P&L, and then you do the balance sheet to bring the system into sync. And out of that next stage is you now can do a rolling forecast. So I'll save that. Just say there, we will auto balance. Now the bold tells me it's in forecast mode. Oh, sorry, in actuals. That tells us which month are the actuals on. And each month just continues that cycle. So what's happening now is the actual that we brought in is being replaced into those figures, and all of the fields are being recalculated. So once that is updated, we can then recreate a rolling budget going forward, which is taking the basis on that. And at all times, we will have two budgets. We will have our original budget, which we have saved elsewhere, and we've got our revised or rolling budget on the basis that what we're trying to do, obviously, take the budget as the current point to the end of a certain time set, and the forecast is revising that on a shorter time scale. What's happening next month, next week, right? So let's say we'll make a record when we've got these. So let's reforecast this record at 555 going forward. So my 4,500 actual 555. Right. So this now will give me the option to look at my variances. Once that calculation finishes for this, we can then look at profit and loss variance, P&L, balance sheet, cash flow and funds flow variances. So that, in addition, we've got our rolling budget, profit and loss. We'll run that up, and also the cash flow, but we'll just have a quick look. So there's our 4.5, and that's the rolling budget going forward. If I take my original budget and run profit and loss variance report, we didn't get any actuals, but we've got except for the ones we entered, but we get a variance of month to date and year to date. What I find a very interesting one is the cash flow variance report. So you don't see anything like this. These are negative as tried to build the balance sheet. We budgeted to collect 2.5. We were better off by this amount, 9 million better off. And there's our variance between our bank, our budgeted bank, and our closing bank, and those sort of figures on a month to date and a year to date basis. So we continue the process. We go back to enter actuals. We do another import. Sorry, we change the month. We do another import and go forward like that. Yeah. So one question. So if you've got a customer that's got a specific payment plan, you could do you can model that by creating a record specifically for that customer. So I'll give you an example. We had in New Zealand, there are two, there's Countdown, right? And one of them pays fortnightly. So we use the profile to balance budget their figures. So we put in 52. And we get that fortnightly profile, and we get that spread for that money. And then the other one, foodstuffs, add record. Paid twice a fortnight. So we put in there 5 million. Right. But you change theirs to payment profile, and you get 50% in the month and 50% next month. So that gives you those two models there. So your payment plan, you can create a separate record uniquely for that customer. Right. Okay. So let's just roll through the last few slides. We'll do that and try and bring all this to a conclusion for you. Right. Just to let you know is that we are mapping the records and have done there to that. We do things like report views, which allow you to bring data into Excel. And this is where you might have Lexio on one hand with Chris's guys and Forecast5 data, and then presenting board packs out to the customers. Those sort of things like that can be done, whether it's dashboarding or similar. Now, we add this sort of solution is to be able to give them accuracies. I've just spent half the morning on site to a client who's stuck in Northland with most of their sales happening in Auckland, so nothing's winning for them, and they just need to make sure it's accurate to go to the bank. Right, so that's key now. Verticals, you asked earlier, some of the things we've done. We have we have retentions and work in progress calculations for stock on hand records, so we can do the contract records. Stock on hand to work in progress for growing and farming, so we can do natural increase. You've got start off with 2 ewes and end up with 4 lambs, etc. Manufacturing, bond made, bill of materials, absorb wages, overhead consolidations, cost centers, branches, divisions within currency, distribution. So by product, any of those sort of things like that. I mentioned briefly the financial CFO, businesses at a high level, not-for-profit is also another one. In the chartered accounting market, I don't think many of you will be focused within them too much, but they have the same sort of needs, and we can give them volume on that. You know, there's food, electric, Apple and Pear, Rainbow's End, accountants,